The strategic pillars of business finance. Navigating complexity in modern accounting in today's dynamic economic landscape. Mastering business finance is not merely an operational necessity but a strategic imperative for organizations aiming to thrive amidst uncertainty. From managing cash flow to forecasting financial performance, the role of finance has evolved beyond number crunching to encompass decision-making that drives long-term value. This guide explores the critical components that form the backbone of effective business finance management, tailored specifically for seasoned accountants and finance professionals seeking to refine their expertise and enhance organizational outcomes through data-driven strategies. Understanding core financial principles in contemporary business contexts. At its foundation, business finance revolves around three core principles: liquidity, profitability, and solvency. These pillars determine an organization's ability to meet obligations, generate returns for stakeholders, and sustain operations over time. Liquidity ensures immediate access to funds required for day-to-day transactions, while profitability measures the effectiveness of revenue generation relative to costs incurred. Solvency, meanwhile, reflects the capacity to fulfill long-term debt commitments without compromising stability. Liquidity management, maintaining optimal working capital levels, prevents disruptions in operations caused by insufficient cash reserves while avoiding excessive idle resources that could be invested elsewhere. Profitability analysis, evaluating metrics such as gross margin, net profit margin, and return on equity, provides insight into how efficiently a company converts inputs into outputs. Solvency assessment. Ratios like debt-to-equity and interest coverage ratio help assess whether a firm can manage its debts responsibly under varying market conditions. Financial planning and forecasting. The bedrock of informed decision-making. Accurate financial planning forms the cornerstone of successful corporate strategy. By projecting future revenues, expenses, and investments, businesses can align their objectives with available resources and mitigate potential risks proactively. Modern forecasting techniques leverage historical data combined with predictive analytics tools to create scenarios based on different assumptions. This enables CFOs and controllers to prepare contingency plans and allocate budgets strategically across departments. Data analytics and forecasts. A game changer for accuracy. A recent study by Deloitte revealed that companies utilizing advanced analytics in their forecasts experienced up to 30% greater accuracy compared to those relying solely on traditional methods. Machine learning algorithms now identify patterns invisible to human analysts, improving prediction reliability significantly. Moreover, real-time dashboards integrated with ERP systems allow continuous monitoring of key indicators, enabling timely adjustments when variances emerge between projections and actual results. Cash flow management. Ensuring operational resilience. Effective cash flow management is crucial for maintaining smooth business operations and preventing insolvency. It involves meticulous tracking of inflows and outflows to ensure adequate liquidity at all times. By analyzing accounts receivable turnover ratios and days sales outstanding, DSO, finance teams can optimize collection processes and negotiate better payment terms with suppliers. Implementing automated invoicing systems also accelerates revenue recognition cycles. Receivables optimization. Streamlining credit control procedures reduces bad debt exposure and improves working capital efficiency through faster collections. Payables strategy. Negotiating extended payment periods where possible enhances cash retention capabilities without damaging supplier relationships unnecessarily. Treasury operations. Utilizing short-term investment vehicles allows surplus cash to earn returns rather than remaining dormant within current assets. Risk management frameworks in corporate finance. Identifying and mitigating financial risks is essential for preserving shareholder value and ensuring sustainable growth. Risks may arise from market volatility, regulatory changes, cybersecurity threats, or operational inefficiencies. A robust risk management framework includes regular stress testing simulations, scenario analysis models, and enterprise-wide risk assessments conducted quarterly by internal audit teams. These practices foster resilience against unforeseen events. Emerging trends in risk mitigation strategies. The rise of AI-powered fraud detection systems has revolutionized how organizations combat financial crimes. Real-time transaction monitoring identifies suspicious activities instantly, allowing swift intervention before losses occur. Additionally, blockchain technology offers enhanced transparency in supply chain financing arrangements, reducing counterparty risks associated with complex international trade agreements involving multiple intermediaries. Capital structure decisions. Balancing debt and equity financing. Determining the right mix of debt and equity financing requires careful consideration of cost structures, tax implications, and investor expectations. An optimal capital structure minimizes overall funding costs while maximizing returns for shareholders. While debt financing typically offers lower costs due to tax-deductible interest payments, it increases financial leverage which might amplify losses during downturns. Conversely, issuing new shares dilutes existing ownership stakes but provides greater flexibility regarding repayment timelines. Cost of capital calculations. Weighted average cost of capital, WACC, serves as a benchmark metric used extensively in evaluating investment opportunities and restructuring decisions. Optimal leverage ratio. Industry benchmarks suggest that firms operating within sectors characterized by stable cash flows often benefit from higher debt ratios compared to cyclical industries facing unpredictable demand fluctuations. Shareholder value creation. Dividend policies must balance reinvestment needs with distribution requirements to maintain investor confidence and support stock price appreciation goals effectively. Mergers and acquisitions. Strategic moves in financial growth trajectories. Strategic acquisitions represent powerful avenues for rapid expansion, market penetration enhancement, and technological advancement acquisition. However, they require thorough due diligence and integration planning to realize intended synergies fully. Firms pursuing M&A activity must evaluate target valuations carefully using discounted cash flow analyses alongside comparative multiples derived from peer group evaluations. Cultural alignment assessment plays equally vital roles in determining post-acquisition success probabilities. Evaluating synergy potential in target selection processes. Quantitative synergy estimates involve calculating projected savings arising from shared services implementation, reduced overhead expenditures, and economies of scale realization. Qualitative factors include brand reputation, compatibility, and complementary product portfolios, enhancing cross-selling possibilities. Post-merger integration challenges frequently stem from misaligned incentive structures among employees or incompatible IT infrastructures requiring costly upgrades prior to full system consolidation efforts commencing. Corporate governance and ethical standards in financial practices. Upholding high ethical standards in financial reporting fosters trust among investors, regulators, and customers alike. Transparent governance frameworks prevent misconduct while promoting accountability across all levels of hierarchy. Implementing strong internal controls via segregation of duties mechanisms coupled with periodic audits ensures compliance adherence even amid evolving regulatory landscapes marked by increased scrutiny towards ESG disclosures requirements. Board composition diversity. Research indicates diverse boards tend to make more balanced decisions considering various stakeholder perspectives during critical strategic discussions. Whistleblower protections. Establishing secure channels for reporting unethical behavior encourages early identification of problematic practices before they escalate into larger scandals affecting reputational damage. Training programs. Regular ethics training sessions reinforce awareness about legal boundaries surrounding conflicts of interest situations commonly encountered within finance functions. Technology integration. Transforming traditional accounting functions digitally. Advancements in digital technologies are reshaping conventional approaches to bookkeeping, payroll processing, and auditing tasks traditionally handled manually by accounting staff members. Automation streamlines repetitive chores, freeing up time for analytical work focused on strategic advising capacities. Cloud-based solutions enable seamless collaboration between geographically dispersed team members while providing real-time visibility into financial positions regardless of physical location constraints imposed previously by legacy software. architectures limited primarily to local servers only. AI applications enhancing audit efficiency and accuracy levels. Artificial intelligence applications now assist auditors in detecting anomalies automatically through pattern recognition capabilities far exceeding manual review speeds achievable manually alone. Predictive modeling assists in identifying areas likely prone to errors warranting closer examination during fieldwork phases. Blockchain adoption continues gaining traction, particularly within public sector audits where immutable records provide irrefutable proof of transactions, evidence useful both defensively against litigation claims and offensively supporting proactive fraud prevention initiatives simultaneously. Globalization impacts on international financial reporting standards compliance as multinational corporations operate across jurisdictions governed by distinct regulatory regimes. Harmonizing financial statements according to IFRS becomes increasingly complicated yet necessary for transparent global communications purposes. Differences exist between U.S. GAAP versus IFRS concerning revenue recognition rules, asset valuation methodologies, and lease treatment classifications, necessitating careful reconciliation exercises whenever consolidated filings become mandatory prerequisites. Translation adjustments. Foreign currency translation effects impact reported earnings figures substantially depending upon exchange rate movements occurring concurrently with respective fiscal year closings. Hedge accounting complexities. Managing derivative instruments employed to offset foreign exchange exposures demands sophisticated hedging strategies compliant with applicable accounting guidelines governing fair value measurements accurately. Transfer pricing documentation. Cross-border transactions require rigorous documentation substantiating arm's-length pricing assertions made consistently throughout intercompany dealings globally. Sustainable investing and ESG considerations in modern portfolio construction. The growing emphasis placed upon environmental, social, and governance (ESG) criteria influences how institutional investors construct diversified portfolios aimed at achieving long-term gains aligned with societal progress imperatives rather than purely monetary rewards exclusively. Integrating ESG factors into investment decisions involves assessing carbon footprints, labor practices, board diversity indices, and anti-corruption policies implemented voluntarily by prospective investee entities undergoing evaluation procedures. Impact measurement tools. Sophisticated ESG scoring platforms assign numerical ratings reflecting sustainability performance across several thematic categories relevant to particular industry segments. Green bonds issuance. Governments and private issuers raise capital through green bonds targeted specifically toward environmentally friendly projects, benefiting communities economically while contributing positively towards climate change mitigation targets set internationally. Disclosure requirements. Regulatory bodies mandate standardized formats disclosing material ESG-related information publicly accessible, facilitating informed choice-making amongst retail and institutional investor populations alike. Future outlook. Adapting to evolving financial landscapes through continuous learning to remain competitive within rapidly changing markets shaped continuously by disruptive innovations impacting every aspect of commerce, including fintech advancements altering traditional banking paradigms forevermore. Ongoing professional development remains indispensable. Finance professionals must embrace lifelong learning philosophies incorporating emerging trends related artificial intelligence, machine learning, algorithmic trading strategies, and quantum computing potentials poised to potentially redefine entire domains soon ahead. Participating actively in thought leadership forums facilitates knowledge-sharing experiences gained firsthand while networking opportunities expand career horizons, exponentially opening doors otherwise closed conventionally through traditional employment pathways constrained narrowly geographically sometimes. Ultimately, staying abreast latest developments through certified programs offered globally equips practitioners uniquely positioned advantageously navigating complexities inherent modern business environments successfully, thereby securing prosperous futures, professionally, personally, simultaneously. Conclusion. Navigating the intricate world of business finance demands a multifaceted approach combining technical proficiency with strategic foresight. As demonstrated through these explorations, Mastery extends well beyond mere arithmetic calculations into realms influencing broader organizational destinies profoundly. For accounting professionals committed relentlessly advancing careers continually, adopting innovative methodologies, embracing cutting-edge technologies, cultivating interdisciplinary skill sets will prove instrumental unlocking unprecedented opportunities, shaping tomorrow's financial ecosystems meaningfully together collaboratively.